News, a special broadcast following the announcement of the Reserve Bank's Monetary Policy Committee today that interest rates will remain unchanged, and we're going to discuss. I'm joined by FNB's Chief Economist, Sizwe Ngedlana, and General Secretary of Trade Union Federation producer, Dennis George. Good afternoon to you, gentlemen. Let's just put you viewers in the picture. This means that the repo rate, the benchmark rate at which the Reserve Bank lends to commercial banks, remains at 7%. And behind me, you'll see the prime lending rate remains at 10.5%, significantly higher. After what we've seen happening is an interest rate hiking cycle that began about 2 years ago, but you can see that it's been intermittent, those rate hikes, and today again the Reserve Bank choosing not to raise rates for now. Let me bring my guests in, starting with you, Sizwe. Was this the right decision at this juncture?
Yeah, I think so. I think it takes cognizance of the fact that the economy is exceptionally weak at present, and the fact that inflation is beginning to moderate. We still do think that there may be scope to raise rates further sometime in the second half of the year, because inflation is probably going to peak above 7% in the fourth quarter of this year. But it's going to be very difficult to justify raising rates thereafter, because inflation over the course of 2017, by our forecast and even the bank's forecast, is probably going to moderate quite significantly.
So let's just clarify, the Reserve Bank saying that its inflation forecast is rising a little bit this year, and these interest rates are aimed at curbing inflation, but from next year, inflation expected to moderate further than previous forecasts.
Yeah, so I mean, I think there's a lot of analysts that think the SARB probably, on balance, shouldn't hike anymore. We don't think that. We think that there is probably scope, because of some of the risks surrounding the inflation forecast, to hike into the peak that we're going to see in the fourth quarter of this year. But I think the point is, once inflation peaks and starts to fall, it becomes very difficult for the SARB thereafter to justify raising rates, even as at each passing month you're seeing lower and lower inflation rates.
All right, Dennis, your first reaction to this?
The MPC faces a dilemma. I think the governor admitted it. You can look at the voting, 5-1. Where one person was indicating maybe a 5%, but I think...
It's less divided than last time, though.
Yeah, no, I think really this dilemma is attributed to the low growth. Because, even though we want to fight inflation in a big way, I think the big objectives of the economy is to have economic growth, and with that is job creation. But I think also the situation that we saw that Moody's, have decided to keep things as it is. They obviously recognize if we can at least, get a little bit of growth projection in the future going forward, that will give hope. But if a person look at the jobs, between January month and March month, we saw huge amounts of jobs have been lost. I look at the figure of 355,000 jobs. I mean, that was even higher during the time of 2008 and 9. And so for us, this dilemma that the Reserve Bank faces, it is quite, and there is a limit to what interest rates can do, because it's a broad instrument that can, deal with inflation, but it can also destroy potential economic growth.
I'd like you both to put your cards on the table, because I suspect we have two philosophically different stances here. You believe that the bank should target inflation. You believe, I understand, that the bank should target growth. That would mean, in a situation like this, where we have high unemployment, low growth, maybe the bank should forget about those inflation forecasts between 3% and 6%, and even drop rates. Is that ideally what you'd like to see, and why? Because I think it's important for people to understand that there are two conflicting views right now of how the Reserve Bank should actually deal with its dilemma.
Yes, now taking from the dilemma that the Reserve Bank is currently facing, they know if they put up interest rates now, it will actually really deal with a body blow to investment, because investment is the main stimulus for economic growth and for job creation. And therefore, you can see from government's own position in the meeting that we had with government, is they are trying to stimulate and to get people to invest. And investment comes when people have confidence. And the situation for the Reserve Bank just to go out and target inflation on its own is for us not the right approach.
But investors wanted an interest rate hike. If you look at the rand, it's
those
weakened.
Those are speculators.
Okay, so that's a different type of investor. Tell me your stance, why you believe it's important that the bank does keep inflation in check in this country.
Because stable and low inflation is a necessary, if not sufficient, condition for what Dennis is talking about. So for certainty, for stability, which then boosts confidence, which then boosts job creation and investment. The other issue is interest rates have been exceptionally low, as you showed in your graph. So, for example, in 2014, we were at a 40-year low. Do you know what fixed investment of the private sector was in 2014?
Yeah,
minus 3.4%. Right. So I think low interest rates, and by the way, real rates in South Africa, as things stand, are still exceptionally low. By absolute and by historic standards, but we're still not going to get much fixed investment. So I think the thing that's constraining fixed investments at the moment is not low interest rates, it's low business confidence. And low business confidence we are getting it because people are complaining about, amongst other things, and these are decision makers amongst various industries, about the fact that the economy has been weak for extended period of time, about the regulatory environment, about the fact that when they open the business day, they see a lot of dysfunction, poor governance, evidence thereof, etc. If you look at, for example, the BR special questions that they ask of the manufacturers twice a year, they're not telling us that interest rates are a constraint to doing business. They're not telling us that low demand is a constraint to doing business. They're telling us that the current political environment is the biggest constraint to doing business.
I think he did hint about that, especially about what happened in December. He didn't want to go into it too much. So let's hold that thought and talk about the bigger issues. We take a short break. I'll be back with my guests, Dennis George and Sizwe Ndlana.